Hi, Rabbits. Research Turtle here. Welcome to our deep dive into the financial machine as of January 2026. We are looking at the liquidity paradigm. The system status is currently stabilized, but to understand where the market is going, we first have to look at the engine room, the plumbing of the financial system, before we check the dashboard. Let's get into it. First, we need to understand the foundation. We have officially moved from the credit era to the collateral era. On the left, you see the old world, LIBOR. It was based on expert judgment, essentially banks guessing their borrowing costs. It was unsecured and spiked during crises. On the right is our reality today. SOFR. This is transaction-based. It uses treasury collateral. It's risk-free. Crucially, in a crisis, SOFR rates tend to dip because everyone rushes to the safety of treasuries. This shift changed the very DNA of how money is priced. So how is this anchor actually built? SOFR isn't just one number, it's a volume-weighted median of about $1 trillion in daily transactions across three massive segments: tri-party repo, GCF repo, and bilateral repo. Because it's backward-looking, we now rely on term SOFR via the futures market to price business loans. Also, keep in mind the seasonality note here. At quarter ends, banks window dress their balance sheets, which can cause temporary spikes in these rates. Now, let's look at how the Fed steers this ship using IORB, interest on reserve balances. Think of IORB as a magnet. Because banks can earn risk-free interest just by parking cash at the Fed, they have no reason to lend money out for less than that rate. This creates a soft ceiling. Below that, we have the ONRRP, the overnight reverse repo, which acts as the hard floor for non-banks. This creates a corridor where the effective Fed funds rate sits comfortably in the middle. In a healthy system, we have this arbitrage mechanism. If the repo rate, SOFR, rises above the IORB, banks should theoretically pull their reserves and lend them into the repo market to capture that spread. This flow of cash keeps the spread narrow and the system lubricated. This is what normal looks like. But late in 2025, that mechanism broke. Look at this chart. We saw the SOFR IORB spread blow out to plus 32 basis points. This was a critical blockage. Even though repo rates were high, banks didn't or couldn't lend. They were hoarding cash. This told us that despite the Fed saying reserves were ample, they were physically scarce where it mattered. Why did this happen? It was a perfect storm. First, a treasury flood. Massive debt issuance overwhelmed the dealers. Second, we hit the QT threshold. Quantitative tightening drained reserves too low. This choked the primary dealers, forcing a spike in the SRF usage. The plumbing simply couldn't handle the pressure. We were collateral rich, but cash poor. Recognizing this danger, the Fed made a critical move on December 1, 2025, the end of quantitative tightening. By stopping the drain on reserves, the Fed put effectively returned. This removed the negative pressure on liquidity. As you can see on the chart, the spread collapsed back to normal levels. The liquidity crisis was averted for now. With the plumbing stabilized, we can finally look at the dashboard to navigate the economy. We have 5 key gauges to watch in 2026: the yield curve, valuations, PMI, inflation, and volatility. First, the yield curve. The inversion of 2025 is gone, but beware, we are in a bear steepening phase. This isn't the good steepening where short-term rates drop because the Fed is cutting to save the economy. This is long-term rates rising due to inflation fears and debt premiums. Historically, recession often follows within 4 to 5 months of this kind of disinversion. Next, the elephant in the room, valuation. The Buffett indicator is at 230%. That's 2.4 standard deviations above the historical trend. It's higher than the dot-com bubble. The bears say mean reversion guarantees a lost decade of returns. The bulls argue that AI has structurally shifted profit margins, justifying higher multiples. Caution is the key word here. Third, we have a two-speed economy. Look at the gap. The blue area is services, still expanding. The yellow line is manufacturing, stuck below 50 in contraction. The risk is infection. If that manufacturing rot drags the service sector down, it's game over. Watch new orders versus inventories closely. On inflation, don't get distracted by the headlines. We need to distinguish between CPI and PCE. The Fed prefers PCE because it captures the substitution effect. When beef gets expensive, people buy chicken. As long as core PCE remains stable, the Fed has room to cut rates even if CPI looks sticky due to housing costs. Finally, the fear gauge, VIX. Below 15 is complacency, above 30 is panic, but the real signal for us tech-savvy investors is the curve shape. If VIX futures flip into backwardation, where the spot price is higher than the future price, that is your get-out signal. Right now, we are watching this closely. So, how do we trade this? Here is your 2026 action matrix. Green light, maintain risk if core PCE is stable and services PMI stays above 50. Yellow light, hedge and rotate if the bear steepening continues or VIX hits 20. Red light, cash is king if the SOFR IORB spread widens past 10 basis points again or if VIX goes into backwardation. Understanding the plumbing allows you to anticipate the flow. Keep your eyes on the spread. That's it for today. Turtle out.